China just imported 836 metric tons of silver in a single month. Let that sink in. That is not an annual number. That is 1 month. The largest single-month silver import figure ever recorded in modern history. And right now, almost no one in the Western financial media is talking about what it actually means or what happens next. Welcome back. If you're new here, this channel tracks the real movements in gold and silver markets, not the sanitized version that banks and financial news networks give you, the actual data. Today, we are breaking down the China silver situation because something has shifted, and it shifted fast. We're going to cover what China's demand surge really means, what the COMEX numbers are telling us right now, why the paper silver market is under more stress than it has been in decades, and what 3 possible scenarios could play out for silver holders in the very near term. Stay with me to the end, because the third scenario is the one nobody is prepared for. Let's start with the raw fact. In March 2026, China's silver import figure hit 836 metric tons, a record. Year over year, from March 2025 to March 2026, silver import volumes surged by 426%. That is parabolic. That is the kind of number that, in any other commodity, would be front-page financial news. So what drove it? 2 forces converged simultaneously. The first was retail investor demand Chinese, consumers buying silver bars as a lower-cost alternative to gold. Silver had already rallied hard, and Chinese retail buyers, who historically pile into a rising market, were accumulating fast. But here's what almost nobody is telling you: the second force was far larger and far more structural. China's solar manufacturers were in a full-scale industrial sprint. The Chinese government had a solar export tax rebate scheme, essentially a subsidy that rewarded manufacturers who completed production before April 1st, 2026. Once a factory secured its silver inputs and formally started manufacturing before that deadline, the rebate applied to those panels regardless of when they eventually sold them. The result? Every major solar panel producer in China was racing to lock in as much silver as physically possible before that window closed. Industrial front-loading on a massive scale. And silver is not optional for these factories. It is baked into the fundamental architecture of the panels themselves. Let me put the industrial side of this into perspective, because it's critical for understanding the price dynamics. Solar panels absorb silver in the metallization layer, the ultra-thin conductive grid lines printed onto silicon wafers to collect and transport electricity. According to the Silver Institute, solar panels consumed nearly 197 million ounces of silver in 2024 alone. That figure has more than tripled since 2015. The solar industry now accounts for roughly 1/5 of all global silver demand. And by late 2025, as silver prices surged, silver's cost share had risen to between 17 and 29% of the total production cost of a solar module. In an industry running on approximately 10% gross margins, that is existential pressure. Now pay attention, because this changes everything. The major Chinese manufacturers, LONGi, Jinko Solar, Ico Solar, are all racing to develop copper-based alternatives. LONGi has begun testing electroplated copper metallization. Shanghai Ico has already launched silver-free cells with 6.5 gigawatts of initial capacity. BNEF analysts estimate solar sector silver use could fall by 7% in 2025, even as global solar installations rise by 15%. Here's the tension, and this is what makes silver's current situation so volatile. Substitution is happening. But it is happening slowly. The engineering challenges are enormous. Pure copper paste oxidizes, diffuses into silicon, degrades performance. Full substitution is still largely confined to laboratory R&D. Current production lines are still dependent on silver, and they will be for years. So we have a window, a structural window where solar demand remains high while substitution is still in its infancy. That window may be closing, but right now it is still open. And that window is exactly what makes the next 12 to 18 months so critical for silver. Now let's talk about the Western market. Because if you own silver, or you're thinking about owning silver, what is happening at COMEX right now should concern you deeply. As of mid-April 2026, COMEX registered silver, the metal that is actually available for physical delivery, sat at approximately 76.8 million ounces. Against that, open interest on paper silver contracts stands at around 575.5 million ounces. Do the maths. That is a delivery coverage ratio of just 13.4%. For every single ounce of real deliverable silver sitting in those vaults, there are 7.5 paper claims stacked on top of it. This is not a sustainable structure. And here is what makes it urgent right now. In March 2026 alone, more than 46 million ounces of silver were demanded for physical delivery in a single month. COMEX delivered 474 million ounces of physical silver in all of 2025. and that was double what it settled in 2024. New buyers were arriving faster than metal was clearing. This is what the big banks don't want you to know. The paper silver market was designed for price discovery and hedging, not for mass physical settlement. When real buyers start demanding real metal, the entire structure comes under stress, and that stress is now visible in the data. At the same time, the three largest silver inventories in the world, Shanghai, COMEX, and the LBMA in London, are draining simultaneously. Since 2021, an estimated 762 million ounces have been drawn from above-ground stockpiles. That is roughly 9 months of global mine output gone. And here is the critical structural constraint. More than 70% of all silver is mined as a byproduct of base metal mining: copper, lead, zinc. When silver prices rise, mines cannot simply choose to produce more silver. They produce what the underlying ore gives them. Supply cannot respond to price signals the way it can for primary metals. The Silver Institute has now confirmed this will be the 6th consecutive annual deficit in 2026. The cumulative shortfall since 2021 is approaching 820 million ounces, nearly a full year of global mine production, consumed and not replaced. There is one more layer to this story that most Western analysts are completely underweighting, and it may be the most important factor of all. China has reclassified silver as a strategic material and tightened its export licenses. This is not a routine administrative change. This is Beijing sending a signal. We understand that silver is scarce, and we intend to control our supply. China used to be a net silver seller to global markets. It is now actively hoarding. Physical silver on the Shanghai Gold Exchange traded at a premium of 12 to 13% above COMEX and LBMA benchmarks in late 2025 and early 2026, one of the largest divergences in the modern silver market's history. When the world's largest industrial consumer of silver shifts from seller to buyer and simultaneously restricts its own exports, the global market fragments. Europe and North America can no longer rely on Chinese refined silver to help balance their own supply shortfalls. The global silver market has effectively split into 3 regional islands: Asia, North America, and Europe, each fighting for whatever physical metal it can secure. So where does this leave us? Let's walk through 3 realistic scenarios. Scenario 1, the controlled repricing. In this scenario, the paper-to-physical tension at COMEX continues to tighten, but the exchange manages the squeeze without a formal default through rising margin requirements, rolling contracts, or quiet cash settlements. Silver consolidates in the $80 to $100 range through mid-2026. JP Morgan's current full-year average forecast of around $81 represents roughly this view. For investors already holding physical silver, this is profitable, but not dramatic. For those waiting on the sidelines, the window to accumulate at reasonable prices continues but narrows with each passing month. Scenario 2, the industrial demand acceleration. Probability, high for medium term. Global solar capacity additions continue at pace. China targets 1,200 gigawatts of solar by 2030, representing a 186% expansion from current levels. India is targeting 280 gigawatts, a 229% increase. Even with silver thrifting and gradual copper substitution, cumulative industrial demand through 2030 could push annual silver consumption toward 950 to 1,050 million ounces, while mine supply cannot scale proportionally. In this scenario, Ghent University and NG Laborlec research projects total global silver demand reaching 48,000 to 52,000 metric tons annually by 2030, against a projected supply of only around 34,000 metric tons. The deficit doesn't close, it widens. Prices do not settle at $80 or $100. Bank of America's scenario analysis has published a target range of $135 to $309 per ounce for 2026. Citigroup targets $110 for the second half of the year alone. Scenario 3, the paper market. Fracture. Probability, low but non-zero, and rising. This is the scenario the financial system is not prepared for. If physical delivery demands at COMEX continue accelerating, and the coverage ratio falls from 13.4% towards single digits, the exchange faces an impossible choice: default on delivery obligations, or settle contracts in cash at prices that diverge sharply from the paper's spot price. When that divergence becomes public knowledge, when ordinary investors and industrial buyers understand that the paper price does not reflect the real cost of obtaining physical metal, the repricing is not orderly. It is violent. Silver's all-time high of $121.62 hit in January 2026 may look, in retrospect, like a preview, not a peak. In this scenario, holding physical silver, not ETFs, not futures contracts, not paper promises, is the only position that actually protects you. Let me bring this together, because there are 5 key things you need to carry away from this video. 1, China's 836 metric ton single-month import figure is the largest in recorded history, driven by a convergence of retail accumulation and industrial front-loading ahead of a policy deadline. 2, silver remains structurally irreplaceable in solar panel manufacturing for the foreseeable future. Copper substitution is real, but years away from mass market scale. Current production lines still need silver. 3, COMEX is under genuine stress. A 13.4% coverage ratio with 7.5 paper claims per deliverable ounce is not a healthy market. It is a market under pressure. 4, China has shifted from net seller to strategic hoarder. That changes the global supply picture fundamentally for European and international buyers. 5, the 6th consecutive annual supply deficit confirms this is not a cyclical story. This is structural. The metal is being consumed faster than it is being produced every single year. My recommendation is straightforward. If you do not have physical silver exposure, the time to think about this is now, not after the next price leg. Paper silver, ETFs, futures, unallocated, accounts, carries counterparty risk that most investors do not fully appreciate. Physical metal, held outside the banking system, does not. Now I want to hear from you. Do you believe silver is heading back above $100 before the end of 2026? Comment silver below if you think yes, or wait if you think there is more downside first. If this analysis gave you something the mainstream financial press is not telling you, hit subscribe and turn on notifications. We cover gold and silver market dynamics every week, and the next video is going to go deep on what the gold to silver ratio compression we saw in May 2026 is signaling for the second half of the year. You do not want to miss it. Until next time, protect your wealth, own what is real.